the purpose for me today is, my hope is to give you guys a basic understanding, is very basic, of how to build a strong financial house, your strong financial plan, so that you can get ready to figure out which are the goals you want to focus on starting today or 2021 if you're thinking down the road, and then what to do to get started, and then the idea is to reap the benefits and help you have less anxiety about your financial plan and your financial situation, especially in the middle of this pandemic. So what I will do right now is I'll share my screen with you, and I have a short presentation to share. And please interrupt me. You can unmute yourselves if I'm in the middle of saying something and you're like, wait, what did you mean by that? Or I have a question about this. Please interrupt me. I find that works best because we immediately answer the questions. And if you have the question, probably someone else is thinking the same thing. So it would be beneficial to everyone. So let me share my screen with you. Okay. Are you able to see my screen?
Yes.
Okay, perfect. So my name is Sharina Sarmiento, and I am an agent with New York Life Insurance Company from the greater Washington area. I work from home because of COVID now, and I help clients nationwide because we're able to help people nationwide, not just in Maryland. My contact information is sent also to Raul. So if you guys want to follow up with me directly, he has my email, my phone number, so he can give you guys that information. Something special about this seminar is that you will get a participant workbook. And Raul was kind enough to say that he would help you fill in the blanks. So during this presentation, you'll see that that I'm going to reference back to the workbook. And pretty much everything I'm asking, I will be showing you guys. You will have a chance to do it individually for you and put in your own amounts, your own personal goals. And that's something completely free to you guys. Okay, so let's talk about the purpose today. As I mentioned, we're going to talk about setting the foundation, and then we'll talk about how I can help in your planning. So think of your finances as a house. So when you're thinking about the house, the first thing is you want to build a foundation. So this is right here at the bottom, and that's your cash flow, your net worth. And this is important because this is how much money you have to start off with to pay for things today. If you lose your job, what you have in your savings is what will help you pay your rent this month. So this is the basics of having a solid foundation. And I will briefly cover each of these topics, and then later I will go into more detail. So as we're talking about your cash flow and your net worth, we're talking about what is your household income. So this includes your income, your spouse's income, and any other income from anyone who lives at your house, in your house. So once you've had these conversations with your loved ones in your household, then you talk about your expenses. So these are some common expenses such as housing, utilities, food, childcare, entertainment, taxes, etc. So in your workbooks, you will have this exact same diagram. And down here, you will have empty spaces to help so that you can fill them in. And you can share them with your family. I have noticed through my years of experience in financials that a lot of times we're not having these conversations with our spouse or a significant other, and so when whatever happens, disaster strikes, no one knows any of the financials of the other people who will have to bear the brunt of somebody passing away, for example, and they don't know if they have checking accounts, bank accounts, stuff like that. So any questions before I talk about the next, your net worth? No? Okay. So when we talk about your net worth, we're talking about your assets. So things like your home, your car, any financial accounts that you have. And assets are, think of them as pluses, and then think of liabilities or debts as your minuses. So that's what you currently owe, like mortgages, loans, credit cards, car loans. And take a second to start thinking about some of the things that you own and some of the things that you owe, and then you'll plug those numbers into your workbooks. If you don't have that information, I would recommend to get all your bills together in one pile and just stack them all and know that you'll be opening those bills, and that's what you are going to enter or give to Raul to help you plan. And that'll help you get some kind of organization if in case you don't have one. Okay, so next we're going to talk about the second level of your financial house, which is risk. When we talk about risk, we're talking about emergency, we're talking about disaster planning, we're talking about planning for if your loved one dies, if they become disabled, if they need long-term care, all those things that we typically don't think about and don't plan for until we become disabled or someone close to us experiences that, but by then it's too late. So this is why Raul thought this was important, so that you guys have the tools now to, in kind of like a path to help you get your financial foundation strong. So moving on, we'll talk about the emergency fund. So the emergency fund, that's exactly what it is. It's a goal for your emergency savings. If you don't have any emergency funds, my challenge to you is to start with $10, $25 each time you get paid, and have that money transferred into a savings account. And it doesn't matter what the amount is. The first goal is to get you in a routine, to start a habit. And even if it's $5, you will have that satisfaction that, you know, this time that I got my income, I put $5 in my savings account. So it's just to get you started in a habit if you don't have one. It's recommended that your first goal is to save $1,000. That's your first goal. It doesn't matter how long it takes you, but give yourself that goal. I need to save $1,000. That's your goal in life. Then you want to save up to 6 months of your expenses. So if your expenses are $1,000 a month, ideally you want to have $6,000 in your savings to help you with in case of an emergency in the future. Do you have any questions about this emergency fund? No.
Sorry, could you repeat
Yes.
the number of you said about the recently said about I yes.
Yes. So we recommend that you save 6 months of your expenses. So if you add your rent, your car, your utilities, your food, and everything together equals, for example, $1,000. So then in your savings account, you should have $6,000. So 6 times the amount of your expenses.
Oh, yes.
And the reason for that is if you lose a job, if you become disabled, if you become sick and you're not able to work, then you have a savings that you can tap into and pay for your expenses until you come out of the crisis. Or
I
does
have
that
a question.
Thank you.
You're welcome. Yes.
I have a question, Miss Rita.
Yes, ma'am.
Uh, if you have $1,000, so I pay a rent, food, car, phone. How I save this money? Everything is so expensive. Everything is so high. So how can save this money? How I can't?
Sure, sure. That happens to me too. So what I did is, and to a lot of people, so what I did is I went through my bank account for last month, and I saw all of the transactions that I did, all of them. I could go back even more, but I just went 1 month. And I noticed that in my particular case, I am spending $15 a month on Netflix. I am spending $25 to $30 a month eating out, McDonald's, coffee, all of that. I was buying movies at home also, like $2.99 movies, and all those things added up to about $200. And I am ashamed to say that. And so in my particular case, I was able to see that I don't need a Netflix membership. I can watch TV for free on YouTube. And so starting to cut back on things that were not necessary, like my Netflix membership, for example. So, or eating out at McDonald's when I can cook at home and be safer than eating out. Those were my examples. And also now that I work from home, I don't have to drive, so I'm using less gas. So I'm able to turn that somewhere. I would recommend that you do the same. We forget how much we spend on things and we forget how much they add up. So, see if are you able to save $500 a month? No. Are you able to save $5 a month? Is that doable, $5?
I don't know. This is very tough.
$5, yes, maybe $1 a week. Can you find $1 a week?
Yeah.
Okay, so there you go. So you can save. And so the point is not the amount. What the point is to get you started doing $1 a week. And you put that in your savings account. You transfer it yourself every week, $1, put in your savings account. And the only reason you're doing this is to trick yourself, to get you in the habit of transferring. Then 1 month, maybe your expenses are less because whatever, don't spend the money on Christmas gifts or holiday gifts. Maybe put some money aside first and then spend Christmas money. But then one day, Mimi, you will have access to more money for whatever reason. And then you already have the habit of savings. And it will be easier to say, okay, now that I know I can do it because I did $1 a week. So let me transfer more for your own benefit.
Okay, thank you.
You're welcome. Does anyone have any other questions? No, okay. I think a way to help us become motivated to save more or start to save is by getting an accountability buddy. So maybe if you guys, one example could be that part of your financial training that you get is to update not the amount of money you have saved, but have you saved each week? Have you saved the last month? And there will be some weeks where you will not be able to save because you have more expenses, and that's okay. And you say that, the last 2 weeks it was bad because my hours were reduced at work, fine. But then you still have 2 more weeks where maybe you can do $1 just to tell yourself I did it, and to prove to the group that you were able to start a new habit, not save a gazillion dollars, but just start the habit, baby steps, progress. We don't want perfection, we want progress. So now that you have your money in your savings, you've got that growing. Now it's important to think about the different risks in your life, like I had mentioned, and we'll talk about the first one being life insurance. And so most people are aware that there are 2 types of life insurance. On this left-hand side, you have group insurance. And typically, these are provided by an employer, some kind of group that doesn't require underwriting. So you don't need to see a doctor. We don't need to see your health records if it's a group insurance. And typically, these group insurances are pretty basic because the employer pays for them. And they also end if you leave your employment. And so that's group insurance. Then on the right-hand side, we have personal insurance. So this is another type of insurance you own, and it requires some kind of medical underwriting. Sometimes now with COVID, we're being more lenient because people don't want to be exposed to labs and all of that. And so there are different types of personal insurance that you can have and you can buy and own that will follow you wherever you go, as long as you're paying the premium for the monthly payment or the premium for the insurance for the policy. The benefit of having your own private insurance is that you will always be covered. You don't have to depend on an employer to cover you if you decide to leave or if you lose that benefit. So that's one of the types of, let me show you here this house too. This is one of the foundations when you think in your head. We talked about the first block being the cash reserve block. We talked about the life insurance. So with life insurance, the earlier you buy it, the younger you buy it, the healthier you buy it, the less expensive it will be. And so it's an investment in yourself because you're able to use it as a savings account. And I can go into more of those details at another time. So something to think about as one of your foundations. The third foundation that I want to talk about out of the 5 is health insurance. So health insurance is also an important part of your financial plan, because if you become sick today and you're not able to work, all your savings will be taken up in a heartbeat. And we have seen it happen to people that we know and we hear in the news. So we talked about the insurances, we talked about life insurance, we talked about health insurance, and now this is disability insurance. So what would happen if you suddenly or your spouse suffered an injury that prevented you from working? Or what if your spouse, partner, had a debilitating injury that prevented them from working? How would that affect your living situation? Do you have disability insurance to help replace some of your wages or their wages? And if not, then where will the money come from to pay for your daily and your weekly expenses? Something to think about. And then the last part of the insurance foundation is long-term care. So with long-term care is when you need extended periods of care and it's not covered by your health insurance. And someone has to go to your house to take care of you, or you have to use your savings to pay for assisted living. So 70% of people turning age 65 can expect to use some form of long-term care during their lives. So something to add on to your foundation, something we don't think about a lot, it is long-term care. And especially we're living longer because we're healthier and we're living more years. And this, I think of long-term care as insurance, so your children don't have to take care of you, or you don't have to rely on people to take care of you when you're older, and we're all gonna get older. Unfortunately, we know that. And unlike health insurance, long-term care insurance is there to help you cover your long-term services. A number of public programs like Medicare and Medicaid may help to pay for some of your long-term care services. There are other ones that are not covered. Oh, that one here. Any questions so far about the different insurances?
Yes, hi, I do. So what does underwriting involve? What exactly is underwriting?
Yes, Deepti. So underwriting is when people review an application and they are checking off for requirements that have to be met. They are checking for your health, so a history of your health. They are looking for your income to see if you have the funds to pay for the monthly payments, the premiums. They're looking at your overall financial picture to see if you're a good fit for this. What else? Some companies require driving records to see if you're a safe driver or not. So those are the main factors of underwriting. A lot of these happen electronically, where insurance companies share a common database. And so when you apply for any type of insurance, one of the documents you sign is you give permission for the insurance companies to get your health records from this center location that is nationwide, and all the insurance companies use. So all of that happens behind the scenes. And typically you will get, like in my company, New York Life, you will have a live representative call you and ask you 5 questions about your health. Things like, have you been hospitalized the last 2 years? Have you been diagnosed with a terminal illness in the last 2 years? Have you used drugs? Those kinds of things. And that is also part of underwriting because they are asking questions about your health to determine if you're a good fit for whatever type of insurance you're looking to get, whether it's car insurance, home insurance, long-term care, all of those. So that's what underwriting is. And there's a team of underwriters that do that job for us.
So who pays for it? Is it included in our premium or it's paid by the insurance company?
Dipti, it's paid by the insurance company. It's a completely free requirement that we have to do.
Thank you.
Excuse me, I didn't get about the underwriting. And I have a question, which is better, company insurance or personal? And another question is, sorry, if you, for example, you had the insurance and you employed, you are employed in the company and they offer you an insurance, what should I do? What should you do?
Okay, I'll try to answer your 3 questions.
Yes.
So let's see here. Okay, Babak, do you?
Yes. Yes.
Babak, okay.
Yes.
So you asked, is it better to have company insurance or personal insurance, right? So it's good to have both. Why? Because the company insurance or your employer insurance typically offers it to you at a discount. So it's less expensive for you to get insurance through your employer because they're buying it at bulk from the company. Okay. And they get a discount. The more employees they have, the less they pay. Typically, these are very small amounts, like $25,000. That will only cover for your funeral costs. That's about it, typically. Some companies have more. So if you have this option, please write down that you want to call HR and you want to find out what are your benefits, because many of us don't know what our benefits are and how do they cover us either. And then it's also important, in addition to have individual personal insurance, because if you get fired from your job or let go, you will lose the coverage the day you leave your job. You will not have insurance anymore. You will not have long-term care. You will not have any of that. Okay,
I have a question. For short term, for example, I have a job offer for 4 months, and I'm not sure about the future, about to continue or my job or not. What should I do for the 4 months? For the it is a job offer, not contract. What should I do? For example, the HR send me as email their benefits, and it is a limited time for 1 month to apply for their benefits. What I don't know what I should do, because my job offer is for 4 months. After that, they may be contract or not contract with me.
Yes. So in your case, what I would recommend, Babak, is that you take the insurance from your job if they offer it, because for 4 months, you will get some kind of benefit at a small price. And so my recommendation is, yes, to take whatever they offer you that you can pay for, to have some type of protection if you don't have any protection now. I also recommend that because of the uncertainty, you have your own personal insurance. So, even after you leave, you can pay your funeral costs, you can pay, if you have a mortgage, you want to pay off the mortgage. If you have children, you want to think of, if you die today, they need to hire a daycare provider to take care of the child. If you're the provider, or so somebody dies, somebody will need to come up with money. So if you have a 10-year-old, you have 8 more years, let's say, of daycare expenses or whatever, then you want to add that into your insurance amount. And if you want to leave a legacy, for example, for your child or your grandchildren, if then you want to think of, okay, how much do I want to leave them that I know they will be okay, when they turn 18, they can access. So all of those things is part of what we do when we ask for questions. What are your plans? Do you want to do this? Do you want to do that? And then we help you add it up. And then we tell you, okay, if you die today, you need $200,000 to pay your home, the education, the funeral costs, so they don't start a GoFundMe account to pay for your funeral costs. And then that's the insurance you get. Yes.
Thank you. Thank you.
Did that answer? Well, you had another question about underwriting. Do you want me to answer that?
Yeah, no.
No? Okay.
No, sorry to bother you. Sorry.
No, don't bother me. If underwriting is just the people that review your application, and they want to check off that everything is going to work. So they're the ones that approve your application.
Sharina,
Yes.
still I have a question with the insurance. Like some people working full-time, some people working part-time. If you pay insurance, it depends how many hours you work, and then how much you pay the insurance. That means, example, I work part-time. I can't afford for 3 people or 4 people for insurance because I'm working part-time. So the only thing what I might do, I just get up with that insurance, because my paycheck, they took all money for insurance. And plus, when you go to the doctor checking, you have to pay the copay. So that means, before you told me how much you save money not easy to save money, because if you have family, $1 you say $5, you know how you do that yourself, but I think it is hard. Can you explain good, like a full-time payment and part-time job is different to payment the insurance?
Yes, Mimi. So you don't have control of that because your employer controls it. So you either take it or you don't take it. In my experience, I have seen that sometimes it's less expensive to have insurance through the state, Maryland Exchange Program. That's the name of the Maryland Exchange. And the reason for that is because it's sponsored by the government, and it's not bad. It's not Medicare, or some people have these things where they don't want to get help from live off the system. It's none of that. It's the state got all of the health insurance companies together, and they said, we are going to manage all of these insurance companies, and depending on your income, you will pay a certain amount for your insurance and a certain deductible. So sometimes if you are low income, where you're working part-time, is not even enough to cover your expenses, much less savings, perhaps you could find a less expensive insurance, not through your employer. Sometimes it's better to get your insurance only by the employer, because it's only one person, and typically it's like $20 or something like that for one person. Typically you start adding people, it adds up more, but perhaps your children or the other family members could have their insurance through the state, Maryland Exchange, Maryland Healthcare Exchange, and that could help you save some money. That's pretty much because they do the job for you of searching for insurance quotes. And let me stop this so I can see you guys better. They negotiate with the health the healthcare insurance companies, they negotiate for you and you get a lower amount. So I would recommend that you Google Maryland Health Exchange or have someone help you with that, or you can also tell the microphone and then get started on that so you can shop for less expensive insurance.
Yeah, thank you.
Thank you, Mimi.
You're welcome.
Any other questions? No? Okay, well, interrupt me when you're ready and I'll keep on the presentation. Okay, so we already talked about having a savings account, having an emergency account. We talked about the different types of insurance. And now that you have your foundation set, now we can start talking about the next step, which is planning for college and planning for your retirement. So the first goal is get the foundation down. Because if you have that foundation down, then you're ready for the next step, which would be planning for college and planning for your retirement. So in planning with your retirement, you have many options. For example, you have some accounts that are set up by the government, like qualified plans or Social Security, or even if you started your own savings account for your retirement. And that's one set of retirement accounts, the government and your own that you saved. Then you have another type of retirement plans, and these are called IRAs, and they're also called 401k plans, 401k plans. And so these are set up so that you can save money and pay taxes later. So what this means is that you pay for this retirement account before they take the taxes out of your paycheck. And this way you don't pay taxes now, but you pay taxes when you take the money out when you retire. Typically, these types of 401k accounts, retirement accounts, they have penalties if you withdraw early. Typically, you cannot withdraw before being 59 and a half. And if you do, you pay a 10% penalty. I know that with COVID, they are waiving the 10% penalty charge if you want to withdraw because of the emergency that we're in. And to find out how much you can withdraw, then you would just call your HR and ask them how much you're able to withdraw if you had an emergency or something. And so when we talk about college foundation, college funding, we're talking about saving for your children. So you have options with those as well. You can go to a bank and you can open a custom minor account. And that means that the beneficiary or the child is in the account and is savings account just for that, for savings. They also have plans called 529. And those are advisors that can open those for you at banks or at investment companies. And those are only specific for college funding. So if the child decides they don't want to go to college, then that could be an issue. Another way to fund college funding is through a life insurance policy, but a permanent policy. So with the life insurance policy, you have two options. You can, where is that right here? Okay, so you have two options. You can either rent the policy, and that's called term insurance, or you could buy the policy, and that's permanent insurance. So when you want to rent your life insurance policy, typically the monthly premium is less expensive. It's a less expensive way to get some kind of coverage. This is a policy that provides only temporary insurance. So that's why the term is part of the name, because it's only for a specific amount of term. So this means that the insurance is good for a year, or is good for 5 years or 20 years. You decide how many years you want to have the coverage. So this is good for people who can't afford a permanent whole life, a permanent premium, because the premium is more expensive. But if they die today, for $25 a month, at least they can have, $200,000 of coverage and their family will be protected. The term policy does not have cash value. That's the biggest difference between term and permanent. What do I mean by cash value? So when you buy a permanent life insurance, part of your premium goes to cover the insurance and the other part of the premium goes to your savings account, one savings account that we will keep for you. So each payment that goes into the savings account is growing month and month and month. So you have two benefits. You have the benefit of when you die, your beneficiaries will receive the payment, and you have cash to use while you're alive without paying any penalties. You don't have to wait until you're 59 and a half. You don't have a 10% penalty, and you don't pay taxes on it. And so permanent life insurance, you're buying it for the rest of your life. Part of the payment goes into a cash account. This cash account grows, it gets dividends, and dividends is the excess money that companies pay out at the end of each year after they paid all their expenses. Then they pay a dividend to the people who own the policies. At least New York Life does, because we're a mutual fund company. So you guys, if you were to buy an insurance plan with New York Life, you become policy owner. So you're a policy holder and you're part owner of the company. So permanent insurance is more expensive because it's building cash value. And you can take that money out and use it for whatever you want. Some people buy life insurance in their 40s and in their 50s, so that when they're 70 and 80, they have X amount of money that they can withdraw, $100,000, $200,000 that they can use for their retirement. Because sometimes if they don't have money saved up for retirement already, this is one way that you can also kill two birds with one stone, have life insurance and pay for retirement. Or you could buy a car or pay for medical expenses, or put the money down for a down payment on a house. It's your own money that you have put aside. Do you have any questions about the insurance, retirement planning and college funding planning?
Shamina, I have one.
Yes.
So what is the ideal age to buy life insurance? Because I think at most you can go up to 20 years, right? And so after 20 years, let's say you are 35, and so your insurance is going to go until you are 55. But now that is when you really know, you really need life insurance because the family is young. So what happens at the age of 55? Can I buy a new insurance, or can I continue that life insurance?
Yes, you can do both. And so the best time to buy life insurance was yesterday, because each day that we grow old is more expensive to own life insurance. So the sooner the better is the best time. The best time to give a gift also. Some cultures, like Asian cultures like China, India, they are very good about investing or giving the gift of life insurance to their children to set them up so that when they're older, they're in a better financial situation than they are. And it's something that comes with their culture, like they're proud of. And so that's the best time to buy insurance. If you have nephews, godchildren, children that don't have insurance, you want to buy it for them and think of it as their college planning or their retirement planning, because they will have not only the death benefit, but they will have the living benefit of using that money. And like you said, they can add money to it as they grow. So that's the best time to buy insurance. So if you don't have insurance today, buy it today, because tomorrow will be more expensive. Next year will be more expensive. Another thing with COVID, a lot of insurance companies are putting restrictions on the people they will approve with COVID. So if you are positive in COVID, you have to wait 6 months before you can apply to life insurance. So the best today, and I can help with all of that.
Hi.
Sorry.
Why? Because I think there's so much uncertainty about COVID that people don't know. Insurance companies don't know. You know, people are dying left and right in a matter of a day, and so I am sure their insurance companies, health insurance companies, they're all. I'm sure they're seeing disability. I have an uncle that was perfectly healthy, worked, and then he got COVID from his girlfriend that he just met. And he went to the hospital and he's been incubated for over 2 months. So for 2 months, he hasn't worked. And now he's disabled on top of having COVID because he can't move his legs. COVID took them away. So you can imagine, you know, his family, he's the breadwinner, how his family is struggling because he didn't have disability insurance. If he dies tomorrow, there's no way nobody's going to insure him now when he's been living off of tubes for the last 2 months.
Oh, yeah.
Yes. So this is really good timing to get your financials straight and start planning. You're not going to have the foundation built in a day, just like it takes to build a real house. It takes months, sometimes years to build a house. The important thing is just to get started.
Sorry. Would you mind put your the number to consult about getting the life insurance?
Yes, Raul, how do you want to handle that?
I have another question.
I was muted. I'll email them your number and email.
Okay.
Thank you, Raul. Thank you.
Would you like me to say it now? No.
Yes.
Yes.
I have another question about the. You said which about, for example, I'm 48. Is the age is important for life insurance? Age.
Yeah.
Yes. For example, I'm 48. What do you think? What's your insurance? Getting life insurance it depends on the age. What is difference? What I can understand, I could understand. Yes.
Yes. So when you get life insurance, there are 3 main factors. The number 1 factor is your age. The younger you are, the less expensive it is. The number 2 factor is your gender. Males typically tend to die younger than females. And so for male, it will typically be more expensive. Let's say, for example, like maybe $3, $5 more expensive than a female. Those are the main 2 things. And then the third thing is your health. And so you have categories of health. You have smoker, non-smoker, preferred, and it all depends on your health. And if you're a relatively healthy person, you know, may have 1 or 2 things here that you take medication for. That's like the average American. And so you're typically in a good place to get life insurance. And there are different tiers depending on your health. So if and the benefit also. So let's say you do your health, you take your life insurance today, and your label is medium. Let's say non-smoker, right? And for the next year, you get in shape, you start eating healthy, working out, and you're in a better health. Then we can send again the doctors for another exam, and we will lower your monthly payment. So the healthier you are, yes, the better your payment will be. So it's your age. That's why you want to get it the earlier, the better, your gender and your health.
Okay. About the retired benefits. What about this retired benefits here?
So with the retirement, when you do you mean in general or only life insurance?
Life insurance to cover the benefit retirement benefits. Yes.
Okay. So for example, let's say someone has a life insurance policy and they have 150,000, let's say, in the cash account of it, and you want to retire today, you know that with 150,000, it will cover you for, X number of years because you already did your research and you know your expenses. So what you do is you call the 1-800 number for the insurance company, or call me if I'm your agent. And then you say, hey, I want to, or you can do it online. We have a portal and you just transfer it straight into your account. And you say, hey, it's 2021. I know my expenses for the year, for the month, let's say, are going to be $2,000. So I want to withdraw $2,000 to cover my expenses for January. And then you withdraw it from your life insurance account. Because you're earning interest on that cash value. So you want to take out what you will need and pay that. With the balance, if, for example, if you use it to buy a car and you bought the car and you got your tax returns and you want to put that money back into the account so that you can use it in the future, you can do that. There are no fees, there's no penalty, there's no cost to that. That's you taking the money out, like you're taking a loan against your policy. And we don't care how you use your money. That's your cash. So 1 month you can use it for retirement. The next month you use it to travel.
Thank you.
You're welcome. My phone number, I'll give it to you guys. And Raul already also sent it via text, via chat. But my number is 240. Do you want to write it or you're good because you have it already?
I keep forgetting I'm muted. It's in the chat box. I put in the chat box her email and her phone number.
You got it.
Any other questions?
Sharina.
Yeah.
Sharina, I'm sorry.
Yes, you
How
can call me
about,
Sharina.
Okay. How about 401k?
Yeah.
401k means it depends your age. But can you explain for me how about 401k, like in your age or after your age? I don't know. Can you explain good with that, please?
Yes. So a 401k account comes from your employer only. It's not something you can go to the bank and open. So the employer hires a company like Bank of America, for example. I'll just use that name. And they have a program where the employer will put money into your pension or 401k account. And you also put money into it. Both of you do. And that's what it's called, a match.
Mm-hmm.
However, there are companies that don't have matches, so that's also something to ask your HR. But typically, they will match whatever money you put in your account with their money. So if you put $50 one paycheck, they will also put $50 in the same account for you. And that money is taken out of your paycheck before they take out your taxes. And because you're paying with money pre-tax, when you take the money out at 65 or when you retire, you have to pay those taxes, because with Uncle Sam, they will never let you not pay. You pay either when you put it in, when it's growing, or when you take it out. Somehow you will have to pay. So with 401k, you're paying before they take your taxes out. And it goes only in an account where your employer can also deposit money in it. When you leave your job, if you don't work there anymore, you take that with you. You take the 401k with you, your money and their money together, and you roll it into a new company. Like you could call me and say, Sharina, I have a 401k when I left my job 5 years ago. It's still sitting there. I don't do anything with it, but what can I do to make some money? So then I can put it in a retirement account that is called annuity. Are you familiar with what an annuity is?
No.
No.
An annuity is what a pension plan used to be.